Hey, how's everyone doing? Good evening, good afternoon. Welcome, welcome.
Hey there.
How's
Hey,
everyone
hey,
doing?
hey.
Hey,
Happy
doing
Thursday.
great.
Happy Thursday. Happy Thursday, everybody.
Yes, indeed. I'm trying to figure out which side of the screen I need to be on here.
Well, what sound looks better?
Well, I want to make sure people can see like the y'all tell me if the am I
No,
on the right side?
no, you're gonna be in the middle of it regardless. Just next time, just make it a little bit smaller. You know what I mean? On the corner. You're gonna be in the middle of it, but I know you had do your thing or AI. So.
Yeah, I was doing it last night at midnight. So under the circumstances, I'm calling this a win.
Oh yeah, I know we have 12 attendees right now. Welcome, 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 Andy, Cecily. Shao always showing up. Zach.
Everyone's so punctual. Thank you guys so much. We're gonna kick things off in maybe a couple minutes just to give a few more
You're
people
welcome,
some
everybody.
time here.
Welcome to Shao. Folks, thank you for coming. Happy Thursday, everybody.
All right, so we have a jam-packed hour here. We're gonna try to get everything in as much as we can. We might run over a little bit, um, but I did want to let everyone know that this is being recorded and we'll share it out. All right. All right. See more people jumping on. Welcome, welcome. So how's everyone's day going? Good, good. We're making sure that everyone is joining without any issues. I didn't get to see the cool background. Hey, Vader. All right, we have a few more folks here joining us. Every time we kick off these webinars, I always say that we're gonna add some intro music, and it always slips my mind when we jump off, and then right in these exact moments, of like I thought of it and I didn't get to it. I need to write it down, or else it won't happen. Joao, Jose, welcome.
Thanks, man. Glad to be here.
All right, guys. I want to value everyone's time, so I know we're at 6:34 Central. We'll give it another minute, and then we'll kick things off. And we'll do
Everybody,
that.
drop in the chat where you guys are located at. For those that we don't know each other. I know we got North Carolina, a couple Dallas folks, Atlanta, okay. ATL in the house, Florida, enjoying the weather, Maryland, Tampa, love Tampa, the family town. South Florida, LA in the house,
Oh, from
go
everywhere.
Lakers, got the West Coast.
All right, guys, as promised, it's we hit the 5-minute mark here, so we'll get the ball rolling, and we'll just make sure that everyone else is able to join afterwards. For those maybe that need a little bit more time or are running a little bit late. So again, welcome everyone. My name is Eddie, one of the co-founders and CIO of DEP, Diversified Equity Partners. We have the rest of the DEP team, as well as our co-presenters and partners, KWETU Avg Capital Partners. So excited to have everyone on tonight, and for everyone who is joining us tonight. So before we get into tonight's deal, I want to tell each and every one of you how we got here, because I think the context matters more than the deals themselves. And I'll share that we look at a lot of deals, a large number of deals on a monthly basis. And we've been walking away from most of them, not because nothing is happening, because we walk into every opportunity looking for a reason to say no. And here's what we keep finding. So deals that were acquired in 2021, 2022 on bridge loans or variable rate loans are just now rolling into refinances in a very in a rate environment that looks nothing like when they were first underwritten. So the asset didn't fail. It was more so of how it was structured. There's a lot of teams, and I see them every day. They're projecting rent growth that is just, you can't validate whatsoever, right? You can do a quick little search check on apartments.com. You can go, number of different sites, and just it doesn't. You're not going to be able to really get what you underwrote to. We fact check everything. We call. We ask about discounts, concessions, and for those other investors that collect all the fees up front and don't have a type of structure where they get paid on performance and on the back end, what we've seen as well is that once they take the upfront fee or acquisition fee, they're not really incentivized, right? They find the nice deal and start the process over. So then your investment is not the priority. So with what we're going to show tonight, our due diligence process and what we cover really dives into addressing a lot of this, but really why this property, why now, what's so important about it. And we're going to talk about, why, or what is it that we take a look at as far as how to say no to a deal. And the reason why we're here, again, is to show you this new deal, Devonshire Lake Dallas, and why this one passed all of those tests. So with that being said, what I'm going to do is I'm going to share my screen here, and bear with me, everyone. So I have too many screens, and I'll share my screen here. So I have to move everyone's lovely face to the side. And with that being said, I'm going to hand it off to Renita, who's going to cover
Kick us off.
The first slide here. All right, can everyone see that?
We gotcha. We can see it.
All right, awesome.
Awesome.
Talk to you,
So
Renita.
welcome, good afternoon or evening, depending on where you are. Super excited to bring to you guys information on this Devonshire Lake Dallas deal, which we're super excited about. The deal and also the partners that we're working with, diversified equity partners. So we're going to be talking to you about a 140 unit property that's located in the northern corridor of Dallas Fort Worth, which we're super pumped about, and let's jump right in. Before we get into the good stuff, y'all, we have to make sure that we cover just a couple of things here. Um, and yeah, this is the disclaimer part. So, want to just make sure that you understand a few things. First of all, what we're going to be talking to you about is an investment, and every investment does carry risk, and want to make sure that you do your due diligence. And we will have time for Q&A here after we complete this. Next thing is that this information is being shared with you. And so what this just says is that you will not be taking it and sharing it with someone else. It is for you. And the last thing is that we are not attorneys. We are not tax accountants, right? And so any questions that you have that would be legal or guidance in terms of your investment strategies, you'll want to consult those professionals. Okay. So now let's jump into it. So what are we going to do tonight? You're going to get to meet the team. You've already met Eddie. We're going to kind of summarize some things at a high level before we double click into it and get into some of the investment highlights for you, which will include the investor projections, right? So what you can expect over the course of the investment, and then whether or not it's the right one for you. And then we'll talk about the property itself. We're also going to double click into the Dallas Fort Worth market and why we're so excited about this market. And then we will wrap up with showing you kind of some other properties that the team has acquired, so you get a sense of what is in the future for this property. And then we will wrap up with some questions and answers and the next steps for you if you decide that this is going to be the right investment for you. So let's jump in and go ahead and introduce the team, and we'll start with Diversified Equity Partners.
Thank you, Renita. My name is Willie Enriquez. I'm the co-founder of Diversified Equity Partners. I'm also the chief growth officer. So that entitles for me to educate investors on multifamily investing and connect them with opportunities like doing due diligence and communicating with investors throughout the whole period. I'm very big on relationships over transactions, and I'm also super big on transparency. So just helping investors make informed decisions. A little bit of my background of myself. I'm a serial entrepreneur. I have three beautiful daughters. I have a 10-year-old, I have a 4 and a 3. I have experience in single family flipping. I also ran a property management company, and I also had a junket and renewal company. And I'll pass it on to Jose.
Yeah, hi. Thank you everybody for being here. My name is Jose Estrada. I'm the head underwriter here for Diversified Equity Partners. My background is in corporate finance, and I focus on analyzing opportunities like this one, making sure the numbers, assumption, and business plan all make sense. And I'm excited to share this opportunity with you guys. I'll hand it off over to Joel.
Wow.
Hey guys, thanks. My name is John Macavilca. I'm a commercial general contractor by trade. I'm licensed in North Carolina, South Carolina, Georgia, and currently pending for Florida. I've done over 165 apartment renovations. I've done over 85 fix and flips. I have my own portfolio of rentals, residential and commercial. I'm stepping into the storage area as well, so I've got some experience in this, and I'm excited to join the team with Willie, Eddie, Jose, and get some boots in the ground, get this thing going, making sure we're all doing good.
Awesome. This is Joao, the first time, kind of a introduction here with the team. So everyone here tonight is getting a sneak peek. We'll have a separate webinar where we'll officially be introducing Joao and his experience and what he brings to the team, and we're so grateful to have him. And this is really the first step as far as coming together and being vertically integrated. So we'll save that for the next one. But just wanted to touch on that. Eddie, again, born and raised in Chicago. My background is in uh, leadership in strategy, software consulting, data analysis, business operations. I combine all of that with my experience in real estate as well. So collectively in real estate, been in both the residential and the commercial side for approximately 15 years now, maybe a little bit more at this point. And what I focus on specifically for DP is following a lot of our methodology, really our tech stack or our systems, making sure everything works seamlessly, but then also more from a strategic standpoint, uh, are following our philosophy, like I said, ensuring that deals that come our way pass our due diligence process. So we have a little bit of that information here. But I'll pass it on to Willie, who can talk a little bit more of kind of who we are, what we've done collectively. And you're on mute, Willie.
Thank you. Thank you, Eddie. Thank you, Joao. Thank you, Jose. Thank you, Anita. Yeah, so DP, we acquired multifamily apartments in Sunbelt and Midwest markets. Currently, we have 115 million assets under management and 475 units. Our last asset we acquired, you can see here, is Puerto Rico. We're actually closing on our second property in North Carolina. Our second asset was Northwoods. Puerto Rico was in Miami. Northwoods was in North Carolina, and our first asset we acquired, which is this will be our second property, is Sawyer's Mill, and that's actually in Arlington, Texas. So it's a submarket of Dallas-Fort Worth, and it's literally a mile away from the Dallas Boys Cowboy Stadium. So we partner up with experienced operators that have experience that actually executed these deals, and that's where we created our PRISM methodology. And our first step in our methodology that we created is partner screening, and we only work with operators that could walk the talk, right? That proven they could buy a multifamily property in year one and execute it, the whole business plan in year 5 and exit it. We also we underwrite the deals. That's what I invested in underwriting mastermind myself. Also, Jose invested in multiple mastermind himself for underwriting. We want to verify these numbers, right? Super important to you verify everything they give you, do your own underwriting, right? And you also be conservative. We also inspect the asset. Super awesome that Joao joined the team because now we have construction, right? We could inspect the physical side. We also go through the financials, the rent rolls, and the operational health of the asset. We also started the markets. We just don't pick any market. We want to make sure we're like in great markets that are showing growth, population growth, and economic growth. And we also, our last one is meet the return standards. So we're not doubling investors' money. We'll say no. And this is what we're big on. And it's one of our models that we had to create it. If we don't trust our own family's money, like our fathers or mothers, we'll definitely won't offer to any of our investors.
All right, awesome. Yeah, thank you for that, Willie, and for diving a lot more into detail. So with that being said, want to hand it off to our lovely co-presenters and co-partners here, KWETU.
Hello, everyone. My name is Daniel Pettigrew. I'm one of the co-founders of KWETU Advantage Partners. My background is I have 30 years of construction, real estate, and also we started off as a single family rental property management, and then we switched to multifamily. That's why we're partnering up with DEP to get more experience in the multifamily home. We like where they're going, and basically we have the same mindset. Uh, Other than that, I'm married to my beautiful wife, Renita Pettigrew. We have 3 kids, and we just had our first grandson. Um, so let me introduce my partner, Renita Pettigrew.
Thank you, honey. Um, I'm actually at our daughter's house here, so I can hear our grandbaby. Yeah, we're super excited to be a part of this deal. We actually live in the DFW area, so we know a lot about the area. I actually have over 30 years experience as a corporate exec, and so I am used to evaluating deals, but also very accustomed to just kind of operational models. And so that's one of the things that really attracted us to this partnership is that we really support the kind of the way that they're vertically integrated and their approach to evaluating deals. And so my background is in technology. I also grew up in a household where my dad was a investor in real estate, so I've been around it pretty much my whole life. So it just seems like a natural evolution for us, given our skill sets and kind of Dan's background. So that is KWETU Advantage Capital Partners. And I think now what we were going to do is just kind of roll into a little bit more about the general partners on this deal.
Thank you, Renita and Dan. So here are our sponsorship partners, Momentum Multifamily. This is Dustin and Hayden. Combined, both of them have 15 years of real estate experience. Both of them each, so that you can add it up. It's 30 years. They did over, just say what, 350 million transactions, and 273. So they raised a lot of equity. I met Dustin on multiple calls through LinkedIn, and just throughout the last 2 years, just seeing what they've been doing in the multifamily space and how they're vertically integrated. So for our first deal, we learned that we need to work with partners that have in-house construction, in-house PM, just more less risk, right? There's always risk in real estate, but that changed, and then we reached out to a lot of firms, see who we wanted to work with, see the alignment, and when we got on call with Dustin, multifamily, and when you get into the space, even though the United States is huge, it's a small world. You know who's doing what, who's doing it the right way, the wrong way, and we seen them, they were doing it the right way, and we knew one of their assets wasn't performing. We asked them like, hey, what's going on? Like, what are you doing to mitigate all this risk? And they kept it raw. And I'm from the East Coast. I like people that keep it raw, keep it real with me, because I want to know the truth. I don't want to to hide anything, and they share the financials for the property. So super excited for and also Dustin, he's a dad too. He lives in DFW, so he is also another person on the team that lives in DFW. Hayden is in Houston. Eddie, you want to go to the next slide? So combined is the 350 million in assets, right? They have 3,200 units plus, and I want to focus on this number right here, 9 full cycles. So in our prison methodology we want to work with teams that exited multiple deals, and our requirement is for teams to have at least 5. And if you don't have 5, the experience you have offset that 5. These guys exited 9. They actually refinanced one of the properties that under the same method, the HUD, assuming a loan, and they just refinanced. So we're super excited about that.
Okay.
All right, awesome. So handing it off to you, Renita.
Absolutely. Let's jump in. All right. So we're going to start kind of high level, give y'all an overall summary of the investment. We'll start, double clicking in, and we'll look at some of the highlights of the investment and some things that got us excited about it. Then we will get into the numbers, looking at what the projections are for disbursements and the overall life of the asset hold. And then Eddie's going to kind of break down what does the capital stack look like. And then I'll cover kind of what the cost segregation opportunity is. So really just very high level. Devonshire Lake Dallas is kind of in the northern corridor of the DFW area. It's pretty cool because it sits right in the middle of Dallas and Fort Worth. It's a 2015 vintage, which is relatively new, and which is a Class A multifamily property, and it's got really strong home values around it, and it's got multiple value add opportunities, which is really the name of the game, and we'll talk about some of those as we dive in a little deeper here. So I think we're going to start with Eddie kind of talking about some of the characteristics of the asset itself.
Yeah, perfect. So wanted to just touch on very few here. While I call a couple of these out, I'm actually going to launch a quick little poll because we want to hear from you guys as well. So, kind of understanding a little bit of where each of you guys are as far as your real estate journey, as well as what are some of the biggest concerns that you kind of take a look at or that you really focus on when you're taking a look at certain investment opportunities, real estate in general. But while that's going on there, we'll give it a few moments there. Wanted to just touch on, I mean, what's so beautiful about this property and all of the amenities, right? So when we take a look at an A-class property, we have our pool, we have a fitness center. It's not just a couple dumbbells. You actually have a gym in there. You have some outside barbecue grills. The biggest things I'd say is you got a little bit of kind of cabana style areas outside where you can, the residents can come and lounge. There's a business center for anyone that can come in and start using Wi-Fi or start doing some work. There's complimentary Wi-Fi and a coffee bar. So for those that work from home, I mean, they don't have to go anywhere else other than just kind of in those areas, right? So just a couple steps down. But really touching on all the different amenities that this property offers. We'll have a couple more pictures here that we'll walk through. We have a few more seconds there on the poll, but very high level. Renita did a great job of touching on the property. And we'll dive into more details here, but the things that I did want to cover are, this is a 5-year business plan or 5-year hold. It is a value add, believe it or not, which is very rare in an A-class property. Typically on an A-class property, you just slightly get a discount and then you just hold it for maybe 10 years, right? So this is different. This one, we're going to walk through why we love this deal. And there's not just one, two, or three. I mean, there's like 5 different reasons. One of them is we're starting distributions within a month 1, month 3, because we'll be well cash flowing. And this is monthly distributions. All right. Now, I mentioned there's a number of different reasons, and this is one of them. There's a 50% tax abatement, meaning that we are wiping away 50% of the property taxes. So when we take a look at creating value, specifically in commercial real estate, we look at it like a business. You have your revenue and you have your expenses. And what you need to do, hope that everyone does, is increase the revenue and decrease expenses. So that hits the bottom line. The more money that you make, the more income that you make, the more that, in this instance, the property is worth. So with this being said, we're wiping away 50% of the property taxes. Momentum Multifamily already has a lot of experience with tax abatements, specifically in Texas. So they focus in Texas. They've done a handful of them already. And when people think about tax abatements or some type of property tax cuts, they think of automatically Section 8, right? That's where my went when I first started diving into this. But I'll touch on 3 key things here. There's a certain amount of units that need to be below the average medium income in the area. This is Lake Dallas, A-class property, A area. And on average, the average medium income here is approximately 120 to 130,000 yearly. So with this tax abatement, the restriction, or what the ceiling is for someone who's making still roughly about 100,000 yearly, right? There's different tiers, but the threshold would be 100,000. This isn't that far away from a college. So the way we take a look at it, and based on the resident base as well, is more of your kind of starter professional, someone who's getting more into the workforce. When we talk about, making six figures, people are still well off, right? So this by no means is Section 8 play. Um, that also, as far as the average medium income, there's also a certain amount of rent that we can raise. Um, we're going to touch on this in a later slide, so I won't go into much of the details, but based on what that ceiling is and where this property is right now, we still have approximately $300 to move up. So not only are we wiping away 50% of the property taxes, we're also increasing the rents by average of $300. And I will end this poll here for everyone
Oh,
so
oh,
everyone
I
can
would like
see. Go ahead.
oh, I like to add that we also getting 500,000 $500,000 less this property. We actually put an offer for 22.5, but we actually got it under contract for 22 million.
Yeah, yeah, absolutely right. Um, so we're gonna dive a little bit more into that and where that kind of stands on a future slide. We'll also share that. I already mentioned that our sponsors already have a number of years of experience handling this, but so do we as well. We also have another A-class property doing the same strategy and ahead of projections. So with that being said, I'll transition over to the next slide here. So there's a beautiful picture of the side here for everyone to look at. So we'll give a few seconds before handing it off. All right, Dan.
Okay. Next, we're going to talk about value added. This is one of the ways we raise the equity on the property. Right now, this slide is showing that we set aside 1.8 million to do renovations and upgrades as far as interior and exterior of the property. Also, we set aside 550,000 for any unforeseen future incidents. Um, this is like you said, this is an A grade property. If people don't understand what A grade is, it's just like the grading system, A to F, A being the best. And as you go down, B, C, D, the property and the area get worse. So like you said, this is an A grade property, and we do not foresee a lot of work being done to this property, but we set aside the money for that. Okay.
All right. So now we're going to touch on investment highlights. If you want to kick this one off, Jose.
Yep. So Devonshire has had consistent ownership in place for 6 years now, with excellent cash flow as a low fixed rate HUD loan of 3.18. With some light interior upgrades, the property has a clear path to achieve between 100 to 200 in rent premiums.
Now, I also mentioned that the property itself has garage spaces here, like showing on the picture there. So we definitely offer a lot of amenities, in regards to just location and the property itself.
Okay, Devonshire is a 11-year-old property, and these are some pictures of what it looks like right now. Location. Devonshire is located on the north side of the Metroplex area, okay, which is the fastest growing economically diverse area in the U.S. Later on, we'll discuss more about that. But right now, Devonshire is also supported by the I'm sorry, Lake Dallas Independent School System, which goes from K to 12. And the area is surrounded by occupied homeowners and is showing that the whole area is stable. And because of that, the rent is is exceeding the prices, and there's a big demand for multifamily home in this area.
This is an overview of Devonshire. The property consists of 140 units with an average unit size of 1,000 square feet and 29. It was built in 2015, and the asset is currently at 90% occupancy. For this deal, we've negotiated that our investors have a 90-10 split with the 8% pref. In today's market, you cannot find a deal like this, and I'll let Eddie kind of explain this a little bit better.
Yeah, so just to add, some short points here. When you take a look at investments like this, what's typical is a 70-30 or 80-20 split. And what that really means is that 80% goes to all the passive investors, all the people putting their money in to make money, right? That's how real estate works. You invest in real estate and it'll start making money. Commercial real estate, excuse me, specifically is very lucrative because the the income, when you push up the income, the value of the property also goes up. It's a multiple of it, just like a business. So here, we actually got the preferred kind of structure and returns, and then we're actually passing all of that to everyone here on the webinar or for those that invest with us. So like I mentioned, typically is 80% or 70%. Here, we're giving everyone 90%. I have not seen a deal like this. We wanted to make sure that we offer something that was very compelling. Also, something another reason why we're doing this deal, and also the 8% preferred return. So that we're passing on straight to everyone who's investing as well. So what that means is that the first 8% of this property, as far as returns go, so the first 8% of returns is going straight to you before this split comes in. So 8% goes to you, and then after that 8%, 90-10 split. So you're still taking home 90% of that. We're going to dive into all the numbers here in a quick second, but just want to touch on that.
And these are the projections for if you were to invest $100,000 with us, what it looks like year 1 to year 5. And on the bottom here on the graph, it shows your total return, the 202,000, 16.2 IRR, your equity multiplier is 2.02x, your average cash on cash is 5.7, and annualized, that's at 20.5%. And I'll let Renita chime in on how that 8% pref is.
Yeah, so what you see at in the top chart, the top row, it really reflects what the expected returns would be for that year. And you see how those grow over time. In each of those years, that's a distinct, that's not cumulative. That would be the distinct yield from that year. And I just wanted to call that out because when you look at the bottom chart at the 20.5%, those numbers don't add up, right? That's not the way you think of it. Think of it as when you look at the disbursements that would be received from the yield up to that 8% over the life of the hold, and you also look at the equity multiple that you end up with at the end of the hold. Your average annualized return would be in aggregate the 20.5%. So just wanted to double click on how you think about those numbers and how those work together.
Yeah, so essentially you a little bit more than double the investment here.
Yeah.
All right, awesome.
We're assuming an existing HUD loan with a fixed rate of 3.18% interest rate with approximately 29 years remaining on the term. This is exciting because right now in today's world, we will not find something like this. And this is one of the main reasons as well that we're pursuing a deal like this.
And I'll add in that at the beginning, before we kicked off the presentation here, we talked a little bit about floating rate debt or variable or bridge debt, however you want to call it. It is 29 years. So tell me, like, where else are you going to get 29 years on a commercial loan? Typically, those are 3 years, 5 years, maybe 7 years. There's a few exceptions out there, but never really like 29. So by the time that we come in, we execute, and let's say it takes us the full 5 years, there'll still be 24 years here remaining that someone else can then come in and also then assume this loan. So that completely minimizes, if not eliminates, any floating rate debt or refinance risk.
And then this is just our fee disclosure page. Transparency is very important to us, so we have everything outlined here for you guys as far as the acquisition fee, asset management fee, and like we said, the 90-10 split with the 8% pref. There is no refinance fee or disposition fee here.
Okay. So wanted to just highlight, we've been, if you notice, we've been kind of highlighting, some of the value add opportunities that go along with this investment. And this is a big one, especially for our high income earner professionals. One of the benefits of being a real estate investor is that you get to take advantage of the cost segregation tax advantage. And what that really means is that, the life of an asset, you get to depreciate that over a 27-year period. What cost segregation would be, and then we're looking at doing a cost segregation study year one, which is awesome. Gives you the opportunity to identify, the portions of the asset that actually, can be depreciated in an accelerated fashion, right? And so instead of having to spread that depreciation, which can be a loss, right, which then you can then take against your taxes, instead of spreading that out over 27 years, once you perform that cost segregation, you can identify, hey, how much of that depreciation that we're expecting to happen over 27 years can we actually accelerate into, year 1 through 5. And so what this really depicts is, depending on your investment level, right? So if you figure $500,000 investment, the expectation is that there would be a realized paper loss after the completion of this study, year one, of $260,000, right? And if you think about that, so if you're investing $500,000, you're getting back half of that, right? Just in terms of the potential, right? Potentially, right? And again, we are not accountants, we are not tax advisors or tax planners. You would have to, make sure that you speak with your tax planner to understand how that may apply to your specific situation. But this is what the opportunity looks like, and then you can see, paper loss of 66,000, paper loss at 150,000 investment. And again, most of this would happen in the year one loss, and then you also would have additional depreciation that you would take over the 5 years hold of the property. So, and it also shows you what the opportunity would be at a $50,000 investment here. So this is a slide that I know I personally get very excited about. So just wanted to make sure that you all understand the opportunity here.
All right, perfect. Yeah, thank you so much for breaking all of that down. So definitely exciting. Not only are you doubling your money in 5 years, there's a lot of things that we took in as far as and evaluated and fact check that would, in other words, mitigate risk, right? So it's not just about how much you can make, it's about how do you protect your investment first. So, there's three things here where you're investing. How do we minimize or mitigate the risk? How do we ensure that upside? And then how on paper, right, write off or depreciate. So, transitioning over, we're going to dive into more of the property, some more specifics, floor plans, more details, rent comps, and a lot of other analysis and checks that we've done and verified. So before we get into that, I'll show this lovely picture again of just the outside of the property. I mean, just love taking a look at it. And while I show this, I'll launch another quick poll. So this is just a quick little question here for everyone. But would love to hear from everyone. What has stood out so far? So I know there's a lot to choose from, and I think here you can only choose one. So, so choose your favorite. But again, we have great common areas. This is specifically more on the outside. We have a couple other slides a little bit later that Willie will touch on as far as other assets the team has accomplished and really how they come in and redesign it. So we'll just wait for a couple more people here, having them. Okay, I'll wait to see if it stops here, but I see people still putting in their answers. All right, gave everyone a minute here, so we'll end the poll and then continue on. Again, probably the only things that I'll cover here, I know we covered majority of them, but 2015 built Class A. As far as plumbing goes, we have, PVC, everything updated. We don't have to worry about cast iron, galvanized piping. I'm in Chicago, so our buildings are very, very old. That's what we always take a look at. I know in Texas, also electrical is a huge, huge concern. So there's copper wiring. But aside from that, I mean, I'll go on to the next slide here and hand it off to Renita.
Yeah, I get really excited when I look at this picture as well. You'll see the property outlined in that triangle in blue there. Notice that it is the only multifamily that is in that geography, right? It's not a bad thing to be the only game in town, right? So also notice in the background there's a lake. That's Lake Louisville. It's a very, very large lake. Might be the biggest in the DFW Metroplex. I think it is. This is not even a mile from that, right? So just another just kind of value add in terms of justification for increasing rent rates and things like that, looking at this geography.
Awesome. So
And
now we'll
yeah,
cover a couple of the interior opportunities here with Jose.
yeah, so these are the unit amenities that we have in each of them, and then basically they're also going to be our upgrading, doing the LED lighting, changing the ceiling fan, patio, the desk, the dishwasher, granite countertops, installing washer and dryers, walk-in closets, vinyl flooring, and there's some photos of how it looks on the inside currently. And then this is a vacancy stress test that we do on here. This is basically what it would take. So we'd have to be at 74.9% occupancy year one in order to still break even. Obviously, right now, as you guys see, we're at 90% occupancy, and it's been running at that or a little bit higher consistently over the last 6 years.
Okay, right here, we're gonna take a look at some of the reasons why we chose this market and this area. Uh, some of the things we look at is market overview, economic drivers, jobs and employment, local economy. Devonshire is basically in a nice area. Some of the market overviews for that area, single family homes are leveling off, but they're still building them. The multifamily market is coming back strong and they're in demand. As far as the economic drivers, growth is fueled by Texas being a business state. Yeah, correct. Business state, and there's zero income tax climate. DFW has been or becoming a major hub for AI, and also the projects and logistics are anchored by DFW International Airport. Going to jobs and employment is a very diverse economic, very diverse economic area. Major employers have to deal with aviation like American Airlines and Lockheed Martin. Finance is Charles Schwab and JP Morgan Chase. And corporate headquarters are Toyota, Public Storage, and AT&T. The local economy in the area, especially the north part of DFW, offers strong equity growth, and the western sector and subsectors offer better entry points and cash flow.
Um,
As you can see here, there's a lot of stuff around Devonshire you really don't have to go too far from. You know, as you see a lot of major stores you may recognize from your area. Plus, if you see some of the key names like Starbucks, Walmart Superstore, Chick-fil-A, and CVS, which means those companies put a lot of money in that, well, to look at how the area is going to grow. And if you see those stores there, that means that area is going to grow big, fast, and be stable for a long time.
I like to add that North Dallas, like all the part of North, like Northern Dallas is growing. Like Frisco used to be all farmland. Now it's like $20 billion. You see, there's 10 cranes out there. So there's a lot of growth, and Lake Dallas specifically, a lot of stuff happening. I just wanted to add that there's a lot of growth happening in North Dallas, and it just keep growing. And when we first started our journey in real estate, we was looking at KC, and we knew about KC before it got in bigger pockets. When we transitioned to Dallas, when we did our market research, roughly like it's like 200 people moving a day. Our recent reports now is like over 350 people moving into Dallas. So it's gonna continue growing and growing, and people need a place to live, right?
Renita, is there anything I know I'm going to pick on you, but you know the area very well, and every time you kind of talk about this specific little sector, like I just get excited. So, is there anything that you can add here?
Yeah, absolutely. It sits right next to I-35, which is the major corridor, north south. That connects all of the cities in DFW, and actually, going down Texas. You think about Austin, San Antonio. So there's certain geographies where people want to be. They want to be close to I-35, and this sits right on I-35. The other thing, you can see the lakes around, and Lake Louisville is a huge lake. There's so much just like family activities and things that are going on around this geography. But the growth going up north, up through between where Devonshire sits, all the way up past Denton, it's literally right in that corridor.
So we're pretty much in where we need to be, right?
Yep. Yep.
Rent comps. Okay. Here, as you can see, the averages right below number 5, you see the averages for a 2013 building, and it's $1,662. Devonshire Lake Dallas is a 2015 building, and their rent is 1,269. You can also look at the very old building, number 3, Lake at Lewis. It's a 2001 building, and their comps are at 1,509, which means we could raise D Devonshire rent roughly $300 without doing anything. And that will also raise the equity of the building. Okay. Um, Even with the abatement, we could still raise the rent $300.
I'll touch on occupancy here as well. So, I mean, Dan touched really on, some huge points here. We have a newer property, and our rents are far below even like the oldest asset from, 14 years ago. On occupancy, this specific seller is facing a lot of distress. So they have other properties that are getting foreclosed on, and they also have a couple conversions that are going sideways. So they need to sell this property to help allocate a lot of capital and then help kind of rectify a lot of the pain that they're kind of in. So, which is why we're getting at a great basis. So thank you, Dan, for touching on that. I'll lightly touch on uh, Devonshire, how much we're getting it at, and then also, like Dan touched on, some comps, right? So we came in, we did the homework. Here's a proof. Um, we fact checked, triple checked everything, and Devonshire right now on the commercial side, we take a look at it from a price per door. So what's the average across the number of units? So since it's 140 units, approximately 22 million, what it costs per door is a little under 160,000. So when you take a look at direct comparables, we're actually a little under $70,000 as far as average. So you can think of it as us getting almost a $70,000 per door discount. So we're coming in and just getting an awesome discount on the property. Also in the area, there's a 2015. There's 1980s buildings that are selling for roughly the same price that we're buying this property for. So talk about a discount. But with that being said, I'll kick it off to this quick slide here, and want to get another quick poll in for you guys. So there's another really quick one, but we're gonna pass it on to Willie, who's gonna cover a lot of the portfolio here, business plan, and then the current portfolio.
Thank you, Eddie. So as we can see, this is on the team's current portfolio. Currently, they have over 3,000 units in Houston with the same they have 5 they executed with the same business plan right here. Same colorway. We plan to do the same thing for this property. This is the first asset they're acquiring in Dallas, and this is same color. Fun fact, the same painter that painted the color of the property right now will be painting the same thing. We'll be repainting our brand. This is currently our assets right here for DP Puerto Vida, similar business plan called the Live Local Act, and currently as right now, we have 209 of the 264 units that are under the Live Local Act, and we applied for 223, so we're still working on it. So we're already ahead of schedule on this property. We're over 90% occupancy, and we're projected to refinance or sell in Q1 2020. And this is our other asset in Dallas. Currently, occupancy is 94%. There's a C plus. You can see it's 2 different. You got the nice property over here in Miami, and then we got a C plus property, 1980 vintage. We're currently 94% occupancy, and we're actually gonna refinance by the end of the year, early next year. So we're super excited about this property, and we actually took this property right here. We're managing in-house, which we love. More control. This is a before on the Henry Liberty Hills, and as you can see, with the same colorways, we'll go to the next page, Eddie. Beautiful asset, Class A. Love these colors, and same strategy out for our property. As you guys can see, this look like a motel on it before, like an old hotel, like you're staying somewhere old, right? And let's see what posts. Super awesome, great pictures, and that's what we plan to do on the same property. And actually, this one right here, the Henry Deerbrook, this is the one that they currently refinance the $50 million HUD loan. So this is the one right here this is a recent one last month that the team actually did.
All right, awesome. So we definitely covered all the potential risk in the market right now as far as investing goes. And we touched on what has really affected a lot of investors, whether it's buying too high, having variable rate debt, having a very short lane, right? 3 years, 5 years, getting into the wrong markets, not being vertically integrated, underscoping a lot of their work, right? So again, getting into deals with investors or sponsors that just don't have a proven track record. So through our due diligence and what we really take a look at, I mean, I think this is the epitome of what we kind of, you know, uh, chase after, right? So we hit on a good number of items here as far as what we look for, how do we mitigate risk, and then how do we ensure or aim towards upside. Now, with all that being said, wanted to dive into investment overview and what are the next steps, right? Or for those asking, okay, what's next, or how does this kind of work? Maybe it's my first one, or maybe it's your second or 10th, but you want to know a little bit more about taking the next step with us. So again, Renita covered this at the beginning of the webinar. This is open only to accredited investors. You can invest the minimum of 50,000, and that's accepted in the wire, IRA, solo 401k, combination, all the above. And we're expecting to close on or before August 3rd. Excuse me. The reason why I say it that particular way is because we're assuming the HUD loan. And anytime that you're assuming the HUD loan, it just takes a little bit of time, right? So this is our target. This is what we have set in place. This goalpost might move. So I'd always, I like to at least my investors tell them get everything in as quickly as possible, because if we need to close sooner, then we kind of cut that window for everyone. All right, so the next steps. What I'll do here is I'll drop the link to the portal. So can't really click on the presentation here, but the first step is reviewing the material that we have on the portal. Next is committing. So what a soft commitment looks like is basically you raising your hand and you're saying, hey, I want to invest, but nothing is binding. You're saying, I like to at least hold the line, right? Hold my spot in the line with this amount of investment dollars. You'll take a look at a lot of the paperwork. We can always jump on the call with you, walk through everything. We've done it a handful of times, and I'm getting ready to share this portal link here. But you can review all the documentation, yourself or whoever else is on, your partner or team. Next, you'll get the wiring instructions, so you can wire, you can fund, and after that, we close, and then you're officially part of this investment property with us here in Lake Dallas. So we definitely welcome everyone to join us and partake on this, amazing asset, right? And everything that it has to offer. So with that being said, I'll transition over here to a couple questions. Renita will cover these, but we'll open it up for some Q&A as well.
Okay, so I'm going to cover these. These are just like typical questions that we get, but be thinking of your questions and making your notes right now. We'll be opening it up for questions in just a moment. One of the things that kind of is important to us when we're working with and choosing partners is, how much is the general partners and the sponsors investing, right? If they really believe in the property, are they putting their money where their mouth is? Well, for this deal, the general partners are investing 500,000 of their own money into the deal. So that demonstrates that they definitely believe in the deal as much as we do. And then when will the distribution start? Another thing, there's a lot of things that we love about this particular opportunity, but this deal actually starts distributions within 1 to 3 months, which typically could be a couple of quarters, right? While the asset gets stabilized after close. So just starting this within the first few months is pretty exciting, and sometimes those distributions happen quarterly. In this particular deal, those distributions are expected to happen monthly. So nice cash flowing, immediate, very early cash flow is a positive thing. A great question that sometimes we get is, hey, is this in a flood zone? Right? Are we investing in something that's going to flood on us? The answer is, first of all, no, it is not in a flood zone. And there are, websites you can go to and you can plug in addresses and you can see whether or not something's in a flood zone. This is not in a flood zone and it has never flooded. So we think from that risk standpoint, we think that's a very, very low risk of any at all. And then how diverse is the local economy? I think we've talked a lot about the local economy and that it is very diverse. Lots of not just different headquarter companies here. I think Dan touched on some of them. There's even more, but it's also just diverse industries, right? It's not all the same thing, right? Um, and I think as we mentioned, the growth of people moving in the area is hundreds a day, and it's been like that for quite a while. And the projections are that that's going to continue. So um, very diverse, just in terms of people coming from all over the country, really all over the world, in terms of jobs. Um, lots of colleges and universities are in the area. So all these are all the things that we think about when we think, what attracts people, right? Who need a place to live. And Dallas Fort Worth checks all those boxes, and this property sits right in the middle of the Metroplex, right in between, Dallas proper and Fort Worth. So, um,
All, all exciting. I want to add the reason we could do monthly distributions because Jose didn't touch it. There's no interest payments on we're paying debt down every year, so that's the reason we were able to do distributions every month. And we do have somebody with their hand raised. I don't want to. Yes, you could go off mute, and I don't want to mispronounce your name,
The,
but ask your question.
the question that I have is, well, a lot of the questions that I had are answered, and I appreciate that. And what I have a question about is, I'm assuming based on what I heard, we LPs are coming on the equity side. There's no debt side. Am I right?
There is a debt side. So the debt side is the HUD loan, but
But we are coming in as on
equity.
the equity side, right?
Yes. Yep, you got it.
Okay. My other questions are, I have two more. How often the LPs will be updated about the project? Is it
Every
monthly,
month,
quarterly,
every
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 month?
month,
Every
every
month.
month, you should receive a monthly newsletter of what's going on. And also, we're big on relationships. You have our number. You could call us. We have strong relationship with the sponsors. So, like, if you need any information, we're one call away or one text away.
And then the third thing, I think Renita just kind of touched up on it. Um, how do you mitigate, we can't predict what's going to happen with people's jobs and stuff. And yes, today it's great. I can move in and rent, but something might happen and you gotta, you know, I mean, you can't predict that. It is what it is. But any thoughts on that?
Yeah, I can touch on that one. So there's a number of different things that I can say, but it's always very unfortunate when there's layoffs. There's been layoffs occurring now. I foresee that there will continue to be some layoffs. Where we want to be, and is a strategic decision, is we want to be where the jobs are going to, and in the locations where businesses are investing millions, if not billions of dollars to create jobs. So will a percentage of people lose jobs, now or in the near future, or maybe a couple years from now? Yes, it always happens, especially with AI. I don't think it's gotten to the point where, and from what I've been reading and seeing, is a lot of business owners or companies or firms expected AI to be a lot more reliable, and therefore laying more people off. I don't think we're there yet. So I don't foresee a huge kind of drop in employment, but I do see it kind of trickling. But with that being said, we go to the areas where jobs are moving to. We saw Elon Musk leaving California to Texas because of what Dan touched on, no income state tax. So we're strategically investing in those areas where businesses are going to, because when the businesses move to, they invest millions, if not billions. They create jobs, and people will then come in and take those jobs. Not just the number of jobs, but also the type of jobs.
Right. And I think the other thing is, what I called out, where is that if you look in the immediate area of where this property is located, there aren't other multifamily, right? So it kind of sits and it kind of feels more like a single family residential area, right? And so I think that there's a different type of demand that I think that this property will command, relative to maybe some other geographies, possibly even within DFW, right, that have more multifamily right there in the area. So this is a kind of a unique, it's kind of like a unicorn. And so I think it is as future proof as you can future proof, right? Um, so given all the things.
Yeah,
We have a question in the Q&A.
thank you.
Tanya, she
Thank you for the
says,
question.
my understanding of the 90-10 split is that when the property is sold, deal closed, the proceeds from the sale are split with 90% to investors and 10% to DP. Eddie, you want to talk?
Yes. So we're actually coming in and investing with everyone. So we're coming in and partaking in that 90%. So the general partners or Dustin, Hayden, they're getting the 10%. So I see a couple questions here. So I'll kind of answer both of them. So that 8% is a preferred return. So what that 8% means is that the first 8% of returns are owed to us, everyone who's investing. We do receive payments monthly, and I'll come back to, because I see another question here as far as returns as well. So maybe I can knock out three questions. So when we take a look at it from year over year, we see year one, approximately 4.1%. Total return for that year, 39.53. Year two, total for that year, 48.53, and so on and so on. It continues to go up. So year one, you get a little under 4. Year two, an additional 48.53. And these percentages here, if it's not hitting that 8%, right? So basically, year one through year five, as far as cash flow goes, is going all towards to everyone investing. The difference comes from the sale of the property. So we're all still getting paid monthly throughout the hold, from starting month one or month three, but we're getting paid monthly every year up until we sell the property. If that 8% is not reached that year, then basically what happens is at the end, at the sale of the property, whatever that difference is or that catch up to get you up to the 8% is owed to you. Then after that 8%, 9%, 10%, and so on, then that's split the 90-10. So 90 comes to all of us investing, and then the 10% goes to Dustin, Hayden, and the rest of the Momentum multifamily team. I hope that answered the question. I hope I answered all three of those questions with that answer. But if I didn't do a great job, please feel free to just drop back in the chat, or just say, hey, I still have a follow-up question, or and you did a horrible job of explaining that.
We have a question. Why change the name of the property?
So you want to take this one, Willie, or anyone else?
Jose, you want to take it on?
Yeah, I got it. So the reason we changed the name of the properties is for multiple reasons. They can have a bad reputation, and we want to change that. So changing the name, we're able to put new flyers. Everybody sees a new name. We put out new banners saying under new management, catches everybody's attention to be able to bring new clients or new tenants, I mean, to us. If we keep the same name, especially if you drive by that area on a daily basis, they're not going to know the property sold. Once they see a different name, see the banners that they're under new management, that's what's going to catch their eye and be like, okay, I already went to that property. It wasn't as good. Let's see what this new management has to offer. Now all these new tenants are going to start looking into Devonshire and be like, okay, now it looks different. It looks like they're going to change everything, renovate it, and they're going to come to us.
Yeah, great answer. I'll also add that, you want to learn from your mistakes. So how we are, we're very transparent. And we made this mistake where we got into our very, very, very first deal. It had poor reviews and we didn't change the name. Kind of, a couple years in that deal, we thought about changing it, but it's so much easier doing it at the beginning than it is like after you acquire it. So that specific property didn't have the best of reviews. There was a management change towards the tail end when the seller was getting ready to, we're all waiting to close and take over. But on that tail end, right before we took over, is when an influx of those bad reviews started coming in. So we really just got kind of stiffed at the end, and we just had to kind of make up for it. We did as much as possible to get that up, and I think we still got it, a little under like 2 stars up, but it took great efforts,
Out of four
pushing
now.
that. Yeah, for now, after a couple of years. Um, Michelle, you had a question here. Do you know if there are any planned multifamily properties coming to the area? Anyone want to touch on that? I see Renita
Yes, the
flashing.
answer is yes. There are, I mean, the DFW is a major metropolitan area, so there are a lot of multifamily properties. And one of the things that happened a few years back was there were a lot of investments made in multifamily properties that had adjustable rate debt associated with it. And so they, maybe just were doing an interest only, and then, their rates are significantly increasing now to what current rates are, which is very different now than what they were back, 2021, 2022, right? And so they're having to sell them because they can't handle the debt increase that's occurring. And so all of those properties are out there and being marketed. But to Eddie's point earlier, uh, all that glitters is not gold. And, there's a very specific model that we're following, which I appreciate that discipline because it keeps us kind of true to our core values, and it keeps us aligned with what are going to be deals that are going to benefit our investors, right? So there's plenty of deal flow out there. The question is it something that aligns with our values? There will be people who for sure will buy them, right? Um, so yeah, the answer is yes.
Yeah, definitely a lot here. It'd be a surprise. But
Yeah.
also, Renita, like what you touched on earlier, right? When we go back to uh, this slide here, on this side of the road, it's all residential. I mean, it's all residential. So the plus of that is that everything around us are all residential homes, and you get more of that homey feel, right? You don't have a bunch of apartments all right next to each other. There's a bunch in different locations, right? And when you go through one property, then the next and the next and the next, it's just very congested. So here we're surrounded by homeowners. Um, so it just, again, it gives more of that homeowner feel. You care more for the property. You want to take care of it. You feel more at ease, more at home. All the commercial side, across the road. So even if they build, they're building on the other side because that's where everything is. That's where the land is.
Great answer. Another question in the chat by Tanya. Great question. We talked about why the property is a great acquisition. What motivated the seller to give up this property with such promising attributes? So, a little bit of story. This deal, Momentum Multifamily put a offer. Well, Dustin put an offer roughly over a year and a half ago. They came second to best of final. Another group got it under contract and it fell out of contract and it fell out of contract. The reason the seller is selling is because they have a lot of, as like Renee was explaining, there's a lot of fires and commercial real estate with floating rate debt and stuff. So they have a lot of fires they have to put out, and they also started getting into conversions, and that's another ball game. So they have a lot of stuff going on, and they were dropping the ball on this asset. They stopped taking care of it. As you can see, we're in the 90% occupancy while all the others are higher than us, right? The rents are 300 below. So that's for the reason they're selling. They have to put up other fires. Eddie, if you want to add to that.
Yeah, I mean, the property is not distressed. It's the owner that's distressed. Foreclosures, like Willie mentioned, conversions, kind of developments that they're doing that are not going well. So they have to sell this to help address put out some fires. And they really just haven't, didn't keep the eye on the ball. The other thing that I'll mention is that when this first went under contract, we actually had a look at this. We know that group as well. Fortunately, they fell out of contract. And what happens in that point in time is I'll paint the pictures. You have a seller needing to sell to put out fires. You have it under contract, and it falls out of contract. So then, what the broker needs to do, right? He needs to find that next person that can actually close. And the seller is expecting the broker to find that person so it doesn't fall out of contract again because he needs to get out. So there's that sense of urgency that then spikes. Hence, why we're actually getting it at almost what is it, $500,000 less than what that initial bid was for. So they offered a little bit more last year. They still don't get it, and then now because they came back around and they really need to sell, our team can close. They actually offered a little bit less, and then we were awarded the deal.
And we have experience with HUD loans, so that's what's super awesome about this opportunity. Um, Another question, what does it mean they are doing conversions? When conversion means like if you start digging into commercial real estate, people will buy a hotel and convert it to apartments, or they'll buy a motel and convert it to apartments. That's what a conversion means, or office to apartments. And that's what they got into. Not everybody could do that successfully. Me and Eddie been in this game for roughly over 4 years, and that's a whole different ball game that we're not in. But there's only, as I know, three successful companies doing hotel conversions in the whole country. That's three. And a lot of people will try it, but it's not easy. I know we have some friends that are doing one in Denver, and they started 2 years ago, and it's not going as planned. So it's just fires, right? People try to they have shiny object syndrome. They see that other people are doing it successfully, so they try it, not having the experience, and that's where they run into trouble.
It's too many risks, especially right now. Money is very expensive. I think a lot of people who are very successful made it happen back in 2021, 2022, even like part of 2023. But that takes time. So the larger the asset, the more you have to go through code, plans, construction, and then money got really expensive. Interest rates went up, and then tariffs, um, inflation, tariffs. So it just kind of continued driving things up. And then when people see turmoil or blood in the water, then they halt and make things a little bit more difficult. So properties start getting foreclosed on. All the lenders and everyone, giving out that money kind of hold it very tight to their chest. And hence why a lot of those are just taking much, much longer to actually get completed. So it's just too risky right now to do any of that, and they have to kind of put that out, or else they're in a much tougher position. All right, so what I'm showing here is a QR code for those that did not get the link in the chat. I know it's way up there now, but it's a QR code you can scan. This is going to take you straight to the portal where you can come in and do a soft commitment. Again, the soft commitment is just you holding your spot, saying, "Hey, I'm interested, thinking of investing this much amount," and it's holding that line. Of course, we have we can only raise so much, and we have a target once that's reached, or the closing comes. Excuse me, whatever comes first, then the spot kind of goes away. So you can kind of hold it, putting the soft commitment showing initial interest, but it's not guaranteed until you sign everything and then you wire. All right. Any other questions that you guys are seeing?
Tanya has a lot of great questions.
All
She said on
right, keep
slide
them coming.
31, there's a basically stress table. Is it accurate that if the occupancy falls below the level, the property be in the red for the applicable period? Also, how does it impact the overall deal? Jose, you're on, brother.
All right, he might have stepped away, or you're on mute, Jose. We'll give it a few seconds, and then one of us can chime in. Okay, who wants to take it?
Go ahead, Eddie.
So to answer your question, yes, it is accurate. So if it falls below that level, essentially what that means is that we are not making money. We can still fulfill all of the obligations. We can still pay the loan. We can still pay everything that's buffered in. Now, this is on paper with a lot of our conservative contingencies and buffers. So, I'll point one thing out. For example, I know that our insurance, we estimated, and I'll do the math here. 140. Oh, sorry. And I'm doing this calculation to just kind of prove how conservative we are. So we estimated, for example, insurance, a good buffer on that to be approximately 100,000, give or take, yearly. We actually put a buffer on that, meaning that we think we can actually get it less, and we have quotes that are actually less, for almost like $20,000 to $30,000 less. So while on paper, with all of our buffers and contingencies, the 74.9%, if we drop to this amount, to this occupancy, then there is no cash flow. But I say I'm going to make two great points here. One of them is we have the buffers. We kind of pump some of these expenses up to give us leeway. So in case something comes back more expensive than what we thought, or there's a sudden jolt at renewal, or something happens, we have that buffer to put us in a good spot. So with all those buffers and contingencies, at 75% first year, if we drop to this amount, no cash flow, and then every year that percentage goes low, because every year we're wiping away property taxes, we're raising the the rents as well. So every year it keeps going down lower and lower and lower. So to answer your question, that is true. So in year one, 75%, no cash flow. Year two, 72, and then go, so on and so on. It goes down. But I want to touch on this slide that Dan covered earlier. We have a property that's at 99% occupancy, and people are paying almost $2,100 on average. We have an older property, 2001. The occupancy is 95%, and the average rent in this property is approximately $1,500. So ours right now, even with the owner, dropping the ball on this, is still at 90%. And our rents are a little under 1,300. So with us reaching that kind of threshold to effectively have 50% of the property taxes wiped away, we're still roughly around that $1,500 mark on a much newer property. And the seller's distress, not really paying attention to this property, and it's still at 90%. I mean, that's how you kind of mitigate those things, right? We'd have to come in and start doing a worse job than the person who is facing foreclosures and has a couple conversions that are going sideways. Going back to a much earlier slide, and I'm going to click back, like 30 times here. We know Dustin and Hayden very well. We have for a number of years. They've acquired, here are the numbers, but the thing that really stands out is just the experience. Collectively, 30 years themselves starting this up and being vertically integrated. So that means the construction is in-house. They have their people on top of it. They have property management in-house. So they're able to control the cost, the quality, the response times, how quickly we can come in and do the very light cosmetic upgrades, achieve those rent increases. But then also the full cycle is a little bit outdated, like a few days or a few weeks now. This should actually be 10 now. But on average, they've doubled money in about 3-ish years. So because we're so conservative, and they've been so conservative as well, they've come in and done this more copy-paste business plan because they've done it on a handful of properties already and have achieved it much sooner than what we put on paper. So on paper, yes, 75%. Do I think it's accurate according to our projections? It is. But I have a really good feeling that we still have a couple percentage points there. But it's all about mitigating risk. So when we take a look at comps, what all the other properties are doing, what we're doing, track record, experience, proof, a lot would have to go wrong to even drop below 90.
Great answer, Eddie. So we're at the hour mark and we want to be respectful of everybody's time. Do anybody have any more questions? Feel free to get off mute, drop it in the chat. That's what we're here for. And Renita, if anybody has no questions, close us out.
Okay. So,
No, somebody dropped, I think somebody, let me see, somebody, no, did somebody drop? No.
no, I think it's just maybe just this slide, have it up if anybody didn't get an opportunity to get the link out of the chat. This is a chat. Also, you should have gotten our contact information. It's actually behind us if you can't see it. You can reach out to us, and then you can see the diversified equity partners. So even if you didn't get answered in the chat, go ahead and raise your hand now. We'll try to answer it. But you can reach out to us, and we're happy to just schedule a call and just talk through anything that are specific questions that you have. And so we just appreciate everybody taking the time to hang out with us this evening and learn more about this exciting property. And Thanks everybody for your time.
All right, awesome. Thank you. Thank you, everyone. Have a great night.
Take care, everyone.
Everybody, take care. Have a great night.